This part is an introduction to enhance your understanding and skills to analyze and interpreted yield curve shapes and changes. As already explained, if a lender and borrower enter into a contract, they agree about the interest rate. A yield curve is a graphical representation of the relationship between the maturity and the interest rate, the yields. Based on collected available market information, this example graph of the daily Treasury yield curve reflects the average interest rate that the U.S. government had to pay to borrow funds, starting from the 13th of May of 2018 for the corresponding maturities up to 30 years. Non-government U.S. borrowers will have to pay higher rates per period that is related to the credit risk assessment by the lenders. This graph illustrates an upward slope or rising yield curve, where interest rates for longer periods are higher than those for shorter periods. The normal shape of a yield curve is an upward slope. Generally, the yield increases are bigger for short compared to long maturities. This is illustrated by the steep and flattening part of the normal yield curve graph. There are several theories that explain the yield curve shape and changes. For example, the liquidity preference theory explains that under normal market conditions, an yield curve shows an upward slope because investors require a higher yield for longer periods, as compensation of postponing their own expenditures, but also because they run higher risks of unexpected events, counterparty default, and potential increased inflation. On financial markets, the interest rates change constantly. Interest rate changes are influenced by many factors, such as supply and demand of capital, economic developments, and market interventions. This causes the yield curve to flatten, to steepen, and to shift parallel up or down. Steepening can be caused by long-term interest rates increasing more than short-term rates, or long-term rates decreasing less than short-term rates. Flattening can be the result of long-term interest rates decreasing more than short-term rates, or long-term rates increasing less than short-term rates. It does not happen often, but market stress conditions, such as the 2008 credit crisis, can even create a downward slope, an inverse yield curve, where short-term yields are higher than long-term. Another influence that can cause changing yield is the expectation of market participants. This expectation about future interest rates can be derived from the current yields by calculation of the forward yields. The pure expectations theory assumes that the market yields are based on the expected future interest rates, the forward rates. This example explains how to calculate the expected forward rate using a simple method. This method is not completely correct, but is sufficient for now. Suppose that the current interest rates, the spot rates, are 2% for 3 months and 2.5% for 6 months. The pure expectations theory assumes that these spot rates are based on the market expectation that the 3-month forward rate after 3 months will be 3%. In market jargon, this is known as the implied forward rate, or the 3s versus 6s forward. The 3s versus 6s is the forward for a period starting after 3 months and ending after 6 months from spot start date. Another example is that a 4s versus 9s forward expresses the 5-month implied forward rate after 4 months from spot. The pure expectations theory says that if market expectations change, the spot yields will change. Now let's have a look at the exact formula to calculate a forward rate. In previous example, the forward rate was calculated neglecting compounding. There was no interest on interest included to calculate the forward. To calculate forward rates accurate, this formula can be used. Next example illustrates how to use this formula to calculate an implied forward rate. In this example, a 3s versus 9s forward is calculated. This is the 6 months implied forward. that starts 3 months from spot date. The 3-month spot rate is 1.25% for 92 days. The 9-month spot rate is 1.35% for 274 days. First, the number of days of the 6-month forward period is calculated by deducting 92 day from 274 day. The 6-month forward period is therefore 182 days. Now the formula can be used to calculate an implied 6-month forward of 1.4%. Please do not hesitate to practice these calculations yourself. Your calculation results may differ very slightly due to rounding amounts. Send me a message if you have questions or remarks. An yield curve change can be caused by changing market expectations about future spot rates. Because forward rates can be calculated from the spot rates, as illustrated in the graph, a forward yield curve can be derived from the spot rate yield curve. If a spot rate yield curve steepens, the forward yield curve will also steepen. According to the pure expectations theory, this implies that market participants expect future spot rates to increase. If the spot rate yield curve flattens, the average market expectation is a decrease of future spot rates. Of course, this does not mean that the market expectation will actually materialize in the future. The market is dynamic and yields shift all the time. There is more to learn about yields, such as zero coupons, and how derivatives can be used by financial institutions to manage interest rate risk from yield changes. Please don't hesitate to send me a message if you have any questions or remarks. Thank you for your participation.